We've been trying to dissect what this means out of the Fed, right? Markets are thinking, was it a hawkish cut? Was it a dovish presser? How would you frame what happened today?
Well, I would say it's not dovish, if you mean by dovish that it reflected pessimism about the outlook for the economy. The outlook for the economy presented by Chairman Powell, and certainly in the projections that all of the members of the committee made, remains a solid, optimistic view of how the economy is going to evolve. So it's hard to say that this is a dovish situation in which they've cut. I actually prefer the way it's been characterized as risk management, as an insurance cut. I think this was the second payment on an insurance policy.
Well, Dennis, you know, I'm going to show a chart, and I know in your mind you'll know what it looks like, because it's going to be the non-farm payrolls numbers. And what you're going to see, if you could, at the right-hand side of the screen is some blue bars which show you how there is a steady downtrend in payrolls. Yet the Fed and Jay Powell continue to call this a strong labor market. This is one of the big things people point to, like, come on, the trend is shifting. What do you think?
I don't think you can expect job gains to go at 175 or something like that, 1,000 per month on an indefinite basis. I believe the economists on the Fed staff and the members of the committee have always believed that there'd be a slowdown in employment markets as we get closer and closer to true full employment. And maybe that's what you're seeing. The key thing is that job gains continue to be higher than the replacement rate, or the rate that covers the newcomers to the job market. And this slowdown, I think, is to be expected. We have a 3.7% official unemployment, and all indications are we're very close to about as full employment economy as we can have.
Well, of course, we did see the manufacturing PMI slip below 50 for the first time since 2016. And another important answer, I think, that Jay Powell gave in that press conference was saying, well, are you worried about running out of ammo, that you don't have much room to cut, you can't do too many, so you've got to go slowly? And he said, actually, he came back very definitively saying, no, the research shows that if you're going to need to cut, and you have less ammo, all the more reason to be preemptive. It seems to me that's another reason why some people are coming away thinking he's one of those people who had the dot looking for another rate cut this year, and he's in the camp that is ready to go if needed.
He may very well be. It's really hard to tell. And I think the key point that he made, and he will always make, is that they made this decision, one decision at today's meeting, and they will wait and see how the data evolve, how the picture regarding risk evolves. And as the situation plays out, they will make a decision in the future about another cut or not. But very hard at this point to know what the picture is going to look like even in November or December. So I think they just have to wait and see what the data tell them.
There is certainly no shortage of diversity of views on the Fed board at the moment. I'm wondering if you can remember a time when there was more division about what to do next, and how you feel Jay Powell's managing that.
Well, certainly in my time, which was 2007 to 2017, the consensus on the committee was much tighter than it is today. I understand the situation. The domestic U.S. economy actually is performing pretty well. He used the word solid, I think, or solidly. The risks are external to the United States, global risks for the most part. The trade-related uncertainty is certainly present in the United States psyche, but a lot of the risks are really global risks, and there can be differences of opinion as to how much spillover the U.S. economy would actually feel if those risks were to develop, to manifest. So I think there's honest differences of opinion about how vulnerable the U.S. economy is at this moment to the global picture.
And of course, Dennis, also making headlines this week was a turmoil that we saw in the repo rates market. Now, the Fed did lower the interest on excess reserves, but they also mentioned that they could start growing their balance sheet again. How will they be able to justify this without calling it QE?
Well, the term that was used is organic growth, which means to some extent the natural growth that will come from currency in circulation, so adding more currency in circulation, which grows pretty much steadily. The refunding of the Treasury's account at the Fed, and then some purchases through open market operations, but not deemed to be QE. So I think there is a pace of growth that will happen naturally to the balance sheet without really calling it a new QE program.
Well, then let me put a finer point on that question, Dennis. Does that mean that, let's say, all the worst things happen, the economy is weakening and heading towards recession, and the Fed's cut its funds rate and says, wow, now we have to do QE. How will we know that? Would there be a big announcement? Will they make it clear that this is now an extra amount of growth to really make that balance sheet a lot bigger? And that's true quantitative easing.
If they undertake a new QE program, and it would have to be a much worse situation than you see today, it will be announced. The markets need to know what the plan is, and in the previous 3 rounds of quantitative easing, all the key information was presented to the markets. So we will know if they feel the circumstances require QE. I think they will resort first to rate cuts, and then they will resort to probably forward guidance. And so we are a long way from requiring a new QE program, and I think it's all very theoretical at the moment.